I did actually sell some of them and got it down a little bit, but I'm still got more of those than anything else, just marginally more than say my Telstra. And the trouble with Woolworths is that they seem to be a pretty reasonable price. And Glenn was telling me they're a very well run company, and they'd had all the supply chain stuff sort of sorted out over the years, and they're way ahead of Wesfarmers as far as their productivity is concerned in being a supermarket. The trouble is, of course, they had the dark clouds of the Masters fiasco hanging over them, because taking on Bunnings was not a smart move by Woolworths, and they came a cropper. And unfortunately for me, they bit that bullet with Masters while I was holding those shares, and what that meant was that the dividends, which were quite reasonable for Woolworths, even though the share price was crap, the dividends actually were clipped by I think about a third, which really was quite a savage reduction in returns for that stock. Now that hurt, and really. I wish I was able to de-invest myself of Woolworths shares earlier in the year. There was one opportunity where the price of their shares went up to $28 a share, and I'd bought them for just slightly less than 30, and I was prepared to take a loss and just to get the extra cash and be able to buy some stock that I wanted, and strategic loss basically. And I learned that's part of the game too. If you're not happy with a particular stock, be prepared to take a loss on your purchase, because the money could be better spent elsewhere. As it turned out, it would have been a great opportunity to sell those stocks, because they dived straight after that. That was the pinnacle for them. And if nothing else, I could have bought back the same stock for probably about $21 a few weeks later. And of course, as Glenn, my mentor in the market, pointed out to me, that puts you in a more protected position in the market, meaning that basically if you pay less for your stocks, then you've got there's less chance of them being battered about. Your returns are pretty well locked in and what have you with your dividends, and you just can't. Especially a blue chip like that, once it's dropped that much, it's unlikely it's going to go too much further. So you are protected to some extent. So the Woolworths exposure has been the worst for me by far. That's what's really put a pall over me. The MRM, not so much, because given the nature of those stocks and the way that the oil price has gone, well, that's just the way it is. And it does appear to be recovering slowly now. So, and I don't have that much money in it, but Woolworths, I have about 10 times as much invested in Woolworths. So that, to me, that is really important. They are still paying the dividends, so I'm still getting a better return than a bank deposit. However, it has been reduced, and it's not good. So, and I just don't feel as though I should be exposed so much to that stock. So I'm trying to keep the investments down to individual stocks down to a much smaller amount, and spread my investments over a much wider range of stocks. And I identified stocks that I wanted to buy, and I made the right decisions actually about identifying the stocks, but there were transport stocks I just couldn't get into. For instance, I thought that the oil price might be low, so that that'd be quite beneficial for those types of stocks, and I was dead right, and the stocks did go up, but I didn't get in. I just couldn't get in. And the price just took off before I had a chance to buy. And the other one was I actually bought Worley Parsons stocks, which is again they're tied up to oil exploration and what have you, an engineering type firm which provides engineering advice and what have you. And they took a huge dive in their share price, and I had a choice to buy those or buy the Leighton shares at the same time. And for some, I just still can't quite understand why I did this, but I ended up buying Worley's. I think just basically because Worley's was slightly cheaper, and the Leighton's, which has been renamed MIM, had been changed, had just gone up a little bit. But as it turned out, they still would have been an excellent buy. And I did say to Glenn, these are the types of shares that I want to hold on to long term. They are my priority. But I still bought those damn Worley ones instead. And that was just a totally unrational, a non-rational thing to do, and I don't know why I did it. But because we are human, we do make crazy decisions like that. And I'm still scratching my head over that one, wondering why I did that. Because the MIM shares have done really well since. They've grown by a third in stock price. So you can imagine the dividend returns are quite good as well. So I really blew it in that one. That really annoyed me. The other one is I sold the Reject Shop shares, and I got a decent profit out of them. But after that, they doubled in price. So, and I not only with those, the other ones where I really stuffed up were the Cochlear and CSL. Both which have gone gangbusters this year. Since I got rid of the stock late last year, they have gone crazy. So, my timing was really lousy getting into the market, and that's why I really should have done much better than I have. I haven't lost my shirt. I'm down on the value of my stocks. I'm probably I would be down about 10%. At least on the value of my stocks since I bought them, which is not a great position to be in. So I've got to wait till they recover. And of course, Woolworths are the biggest drag on those because they really took a hit. They're in the recovery stage, mind you, but it could take quite a few years for them to recover. So I've got to look at a long-term strategy to de-invest myself from them, whether I just get rid of a lot of them or just get rid of some of them. I don't know. It's ironic too, because I actually shopped at Aldi quite a bit, and I knew that Woolworths and Wesfarmers were being affected by the inroads that Aldi were making into the supermarket shopping trade. But I still bought these Woolly shares because they were, they seemed to be a solid investment, and that's what I wanted as a new investor. I didn't want to do anything too flashy, so I wanted to buy a lot of those because they were, reasonably solid returning stocks. The other ones that I got that went sour on me was the ANZ. For some reason, the outgoing CEO Mike Smith, the last report that he had, the profit of the company dropped. I think it was around 15%. Don't quote me on that, but it was a huge reduction in profit, and so the dividends were slightly clipped on that in that case. Nowhere near as much as Woolworths. It's only a couple of cents here and there, but rather than growing, they were actually reduced a little bit. So I got a double whammy, and I had quite a few of those shares as well. The only one of the big three holdings that I have, which is actually Telstra, is the other one that I invested in. They have actually done okay as far as dividends is concerned. So they at least made up a little bit for the others, but I really missed out on some star performers because I didn't invest widely enough, and that's a mistake I won't make in the future. But I've got to dig myself out of a hole now, so it's actually I've been increasing my holdings of cash over the last few months, and I've actually sold some shares, and now I'm in a position where I can actually buy shares if I see any bargains around. But it looks as though the market's in a bit of a recovery phase, which is fine. So my options are limited there to find bargains. So I might just have to hold on to the cash a bit longer. The biggest mistake I made overall in investing is I jumped in with all my money and bought up as many shares as I possibly could in as short a time as I could, just to get that dividend return. What would have been more prudent is if I'd just done that with half of my money and then just checked out the market, watched it for 6 months to 12 months, and got a really good feel for it. and then invested the remainder of my money. As it turned out, the market went in for an incredible slump. You know, my timing could not have been worse, really. It was the beginning of 2014. Things were going well, but around mid-year 2014, the proverbial hit the fan, and the market started to tank. And the market hasn't really been doing particularly well in Australia up to that point since the GFC. And the funny thing is, you'd think it would have recovered, but no, it hasn't. And it took another dive, which wasn't expected. But again, you just got to cop that sort of stuff with investing in the stock market. Now, the bottom line for all this is, yeah, I've made a lot of mistakes. I've got myself into a bit of a hole with Woolies, but I can hopefully get myself out of it. It's not like they're worthless shares. They've just taken a bit of a clip, and I think they will recover, and I'll have a chance to sell them, hopefully at the same price I bought them at, or maybe take just a little bit of a loss to get my investment down in those, and invest elsewhere. The one lesson I've really learned is to be ruthless in holding out for a low price for the stock you want to buy. Don't buy stocks that you think are overpriced. You know, you've got to be really hard-nosed and wait for your opportunities, because the stock market always goes through periods of fear. The last one I think was the Brexit exit with the UK. That caused a bit of fear within the market. So there's always going to be situations where people are going to be freaking out as investors. They're pretty scared people. They're like a herd of horses is probably a good analogy. They're that easily scared, spooked by market events. So there's going to be opportunities, but if you don't have spare cash, you've got to have a certain amount of cash in your portfolio just anyway. I would never use all your money. That's crazy. You've got to hold some cash, but I've now got an excess that I can use to invest. So I'm in a position to take advantage of the market diving. It's like when Glenn saw he got Telstra shares for less than $5 at $4.99. I knew that was a good buy, and I would have loved to have bought them, but I'd put a line in the sand. I didn't have the cash. I just could not participate in that, even though I knew that was good buying. The excellent returns on the money because it's such a low stock price. It's almost like buying them in the past because the price dips that much. That is such good buying. So I couldn't do it, and I stuck to my guns. I said I wasn't going to do it. And you've got to be pretty hard-nosed about it. I think you've got to make a few rules there along the way. But really, you've got to know your stocks, study them, use the ASX site. It's got some good intel there. Watch a few of those videos from those experts. They're not bullshit artists. They're actually providing pretty good advice. And if you're not sure, just write down the stocks from a previous video they've done and check out how those stocks did in the following year. I'll give you a good idea of seeing what their predictive abilities are. I mean, they can't hide it from that. Those are the facts. So I did that, and I found that there was some very good advice there. So use that by all means. It's all free, and anyone can join up to the ASX site online, and it's an invaluable resource. The other thing is if you can, get yourself a mentor who will help guide you through investing in the stock market. It can be a scary place, but it can also be very lucrative if you're very careful the way you invest. Just look for great dividend returns. One thing you do need to be aware of, though, is even blue chip dividends can be reduced. I was led to believe that was pretty well unheard of, but that's not the case because it did happen with Woolworths. So you can still take a clipping of dividends, but you are in a much safer place with a big blue chip company. My thoughts on somewhere like Woolworths, what I want to get at is I just don't see there's a great future in that type of a supermarket unless they come up with a new way of selling supermarket produce. I don't see the growth in that industry anymore. And I guess that's why they wanted to do the Masters thing. They needed to look at options of growth, and they picked the wrong target there. So their corporate strategy was stuffed. It appears as if the new managers are a bit better at what they're doing, so that's why the price has actually bounced quite a bit. And maybe there will be an opportunity for me to reduce my holdings, and that'll be the first phase of getting my whole portfolio more balanced. But you know, it's not rocket science. It's just maybe you've got to have a good nose. You've got to have a sixth sense about where stocks go. Watch them regularly, get a feel for them. They seem to have personalities. Don't be afraid to do a lot of research and just watch and look at how the stocks are going. But occasionally my tips would be that if you can get really good qualities like stocks like Cochlear or CSL at a low price, Ansell's another one in the health areas. There's some good stocks. They've got growth potential. So wait on the sidelines until there's a really bad day, a lot of pessimism around. You know when things are really good buying, when they start reporting the stock market in the media. If it's a headline news event, a negative one, then that's almost a classic buying signal for the market. There is, of course, the danger that you could be just at the beginning of a falling market, which could go for some time. And the dip that I experienced, in the last 12 months, is quite a long dip, and it was never expected to be like that. But it might be because it's a post-mining boom situation, and there is a bigger readjustment taking place in the Australian economy. But there are still plenty of investment opportunities out there. So I would say, if you're interested, go for it. Probably don't I would say don't spend all your money on the market. Spend a proportion that you can afford to, and use that to get familiar with the market and the mechanisms, the stocks that you have. Check out a number of stocks and get a feel for the ups and downs of the prices. And remember, there will be good buying opportunities out there if you're prepared to be patient, and you need to be patient. The other tip I would say is, if you want to trade, don't get too greedy. If you find that the stock that you've bought has gone up sufficiently to provide you with a decent profit, take the bloody profit. Don't just hold on the off chance it might keep going. You'll get caught out from time to time. It will keep going up, and you'll lose potential profits. It's happened to me. But you've got to have some. Well, look, there's two ways you can do this. You can say sell half your stock at the price that you think's reasonable, and then hang off on selling the other half on the assumption that the price might even go higher. And if it goes lower, then at least you've got you can sell it and at least know that you've got a decent return on the first lot you sold. So it just protects you. You don't have to buy and sell the stuff all in one lot. I've actually reduced the parcels that I buy and sell because I want more flexibility like that. So there's a few tricks like that. There's a few ways you can go about it. But the bottom line is you've got to get good stocks, and that's an art. Although getting the standard blue chips is a pretty safe option. But if you're going to go the way of getting the standard blue chips, what you've got to do is find them get them at a good price. Just check out the prices, watch the charts, look at the prices, and wait for them to dip, and then go in and buy them, because it does give you that extra protection. So look, it's not rocket science. It can be a scary place, but it can also be very rewarding. And I've enjoyed the process over the journey. It's not like I have to have all this money anyway. I'm a single guy, so I don't have a family, and it depends on your circumstances. If you're starting to lose sleep at night, I would suggest that you're probably not to continue on with. It may not be good for your health, but I've had that for short periods of time during my investment. I haven't had any problems with sleep for a long time. And I'm fairly comfortable with where I am at the moment. I have a strategy, and I'm prepared wait it out till the timing's right to buy more shares. You just got to get that patience together, and you've got to have that strategy. And if you do that and you stick to your guns, chances are you'll do pretty well, I think. But just stay. I'd say stay clear of the mining stocks and stick to, say, fundamental blue chips if you just want to be an investor. If you're more a gambler, by all means go with those other types of stocks. But if you're just you want to get decent returns on your money, don't get too greedy. Just be prudent with what you invest in. You may be surprised some of the returns are going to be great. I missed out on some really juicy ones. I know I did, and I'm really pissed off. But I haven't lost my shirt. I am down a little overall, but I did make trading profits. So my actual real reduction in wealth isn't anywhere near as great as it might have been, and I'm still getting dividends from nearly all my stocks. So that's what it was all about, and I fulfilled my goal. I'm definitely doing better with having my money in the stock market than in the bank, and that's what I was looking for. So mission accomplished as far as that's concerned. I hope this has been of some interest to you. It's my honest appraisal. It's just my own story, but this is a no bullshit account of what's happened with me, and so if you're interested in investing, I would say do it, but just do it carefully. Do your due diligence, and it can be very rewarding because you are investing in real companies, and it's not like gambling on the track or whatever. I find it's much more interesting than that. This is actual real people we're dealing with, real companies and real wealth, and I find it fascinating. So hopefully you will too, and hopefully you'll have a bit of luck, and I'll keep you informed on how it's all going from time to time. I hope you've got something out of this.